Obviously, COVID is changing a lot about how we live our lives, how flexible our lives can be. How exactly does Picasso work?
Sure. Well, you're right. I mean, COVID now has us untethered from our corporate headquarters. People can now live and work where they want to live. So the way Picasso works is we take this very underutilized asset, which is second homes, and we try to increase its utilization through co-ownership. So what that means is maybe if you've been thinking, gosh, I would love to have this vacation home. It's $500,000 on the lake, an hour away, but does it really make sense? Am I going to use it enough? Can I afford it? Instead of buying the whole house for $500,000, maybe buy half of the house or a quarter of the house. Picasso will buy the rest, and then Picasso turns around and resells its portion to other co-owners. You then use the Picasso owner app to schedule your stays, and Picasso does the property management. So it allows second homeowners to right-size their ownership of the home. Rather than owning 100% of a home, you're only going to use a fraction of the time, own a fraction of the home.
That said, we're in a recession. You've got tens of millions of people who've lost their jobs. You've got a lot of uncertainty about what's happening next week, let alone next month or next year. How many people can afford a second home right now or want to make a big decision like that, even if you're only talking about 1/8 of the cost?
Sure. So, I mean, historically, second homes, which are this joy to own, have only been accessible to the 1%. And what Picasso aims to do is to make it accessible to the 10% or the 25% or the 50% through co-ownership. So, if you do the math, if you think about, say, a $500,000 second home that you're buying perhaps a quarter of, and you're financing with a mortgage through our mortgage partner, you're only putting down $50,000 to $100,000 to have access to, say, a quarter of a $500,000 home. So it is achievable, and especially now when people are being more flexible about thinking where they want to live. It's as you said in the beginning of the segment here, second home ownership is a huge oasis for people, especially in a COVID period. And I don't see that changing. I actually think that we're entering really a permanent state of kind of flexible living environment where people now are reconsidering what their living situation is. And this makes second home ownership, maybe not full second home ownership, but I believe partial second home ownership, incredibly appealing.
Now, obviously, you co-founded Zillow. You were the CEO for a decade. What is your outlook on the real estate market? We're hearing these conflicting narratives. One, it's the end of the cities. One, that's a myth. Should you buy? Should you sell right now? Should you just stay put and wait this out because it is so uncertain? What do you see?
Yeah. So, I mean, the truth is that nobody really knows, right? I mean, there are a lot of pundits, including me, speculating about this. But if you tell me what's going to happen to companies and how much they'll require people to be in the office, I can tell you what's going to happen to housing. Now, I have a point of view, which is that companies are going to switch to a hybrid model where employees are in the office maybe 1 day a week or 2 days a week, or maybe 1 or 2 days a month for kind of more knowledge workers or tech companies. But the idea of you being tethered to a corporate office, a corporate headquarters, and going there every single day, 9 to 5, I think that's going to go the way of personal offices, sort of what personal offices were to the 80s and open offices were the 90s and 2000s. I think you're going to see this hybrid model. And if I'm right, then I think you're going to see people moving not to the woods necessarily, but outside of a city center to the suburbs. So you don't have to live in San Francisco, you can live in Napa Valley. You don't have to live in Santa Monica in Los Angeles, you can live in Santa Barbara. You can live an hour or 2 hours away from your office if you're only commuting there 1 day a week or 2 days a week. And if self-driving cars become a real thing in 5, 10, 15 years, then that commute becomes even more productive and you'll see even more spread away from city centers into the suburbs and more rural areas.
Meantime, you've got very interesting things happening in the public markets. And again, huge measure of unpredictability, though somehow they keep going up. You just filed to go public with your SPAC, Supernova. You haven't found a business to merge with yet, but what are your intentions and ambitions here?
Sure. So I'm in the quiet period right now with my SPAC, so I have to be very limited in what I can say. What I can say is that I think it's obvious that SPACs and direct listings, and I'm on the board of Palantir, which went public yesterday through a direct listing, but SPACs and direct listings both offer an interesting alternative way for a private company to go public. I think they'll continue to gain market share at the expense of traditional listings. So I'm long-term bullish on SPACs. I think they're a solution to some of the challenges that traditional listings come along with. But in terms of what specifically Supernova might be up to after we go public, you're going to have me back on your show, Emily, to answer that question, hopefully in a couple of weeks.
But what? Okay, let's talk more broadly then. What about the diligence? I mean, the diligence process is completely different than it is for a traditional IPO. How can we know whether to trust these companies, whether this is a good investment?
Well, there are two pieces to diligence with SPACs, right? There's when the SPAC goes public, when you're right, there's not much to diligence except the management team and make sure that the financials are audited, but there's not much to see there because there's no operating business. And then there's the time of the SPAC merger where the SPAC merges with a private company. And then there's plenty to diligence at that point in time because there's an operating business to evaluate. As I say, I think SPAC mergers and companies going public through SPACs are a really good alternative to a traditional listing. But you'll have to wait for me to talk in more detail just because of the restrictions of the quiet period.
Now, got to ask you before you go about Palantir. Obviously, they took the direct listing route, the unconventional route. The shares didn't quite hit that market cap or the valuation that they fetched on the public markets back in 2015. Do you think a direct listing was the right call, and can they get there?
Yeah, I think a direct listing was the right call because they didn't need to raise primary capital. So like Asana, Palantir had plenty of money in the bank, and so they didn't need to sell shares in the IPO. So a direct listing is a much more orderly way to move from the private markets to the public markets than a traditional IPO if you don't have to sell stock at the time of the listing. It was a very smooth offering. The company is now publicly traded. There's liquidity, and I think the company's off to a really good start in this next chapter of its growth as a public company. So I think it was a smooth day. Yesterday was a good day for direct listings with two companies executing really well with their direct listing model.